Hello, friends. Welcome to another episode of ET Market Smart Talk. And today we are discussing a question that many investors face. Debt mutual funds versus FDs, which is better? And probably we'll talk much more than that as well. Well, to help us navigate this, we have with us Abhishek Bisan, who's the head of fixed income at Kotak Mahindra AMC. Welcome, Abhishek, and thanks for joining us.
Thank you, Kshitij. Thank you so much.
Thank you so much for taking the time out. And before we go ahead and talk about our the theme of the show, let's start with the tariff war as well. In fact, U.S. Treasury yields fell to a multi-week lows on Friday following President Donald Trump's threat to impose a massive increase in tariffs on Chinese imports. Will it have any bearing on India as well, Abhishek?
Yeah, sure. So, whenever some uncertainty erupts in the global markets, definitely it has some amount of impact. But this kind of uncertainty related to the geopolitical events and the tariff, especially, has theoretically impact on the currency. Now,
Sure.
with through the currency markets, it can impact equities and debt as well.
Mm,
But however, given our fundamentals, which, for example, inflation, which is fairly benign, we have reasonable GDP growth. If you look at
mm,
current account deficit, is fairly manageable. If you look
right.
at FX reserves, we have $700 billion around FX reserve as of now. So we are fairly
Mm,
comfortable on our macroeconomic fundamentals. Therefore, while the currency has depreciated relatively, but it has not impacted the fixed income. However, given the sectoral impacts, etc., on the tariff, equity markets have got impacted, which is fair. So that's the only limited impact. In general, had the macro would not have supported, then definitely
mm.
yes, that also would have got adversely impacted. But this time around, given the strong fundamentals, our fixed income markets have not reacted adversely because of that.
Right. And the mutual fund data also came out recently, Abhishek. I'm sure you're tracking the same. And in
Yeah.
fact, if you can help us identify what were the key drivers behind the, you could say, more than 1 lakh crore of outflows from debt mutual funds in September 25.
Yeah, sure. So if you, Kshitij, if you observe mutual fund as a vehicle is
Hmm.
used by corporates and large HNIs for cash management tool as well, and by the retail or the corporates for their investment vehicle as well. So if you
Hmm.
look at the product array from the liquid to the ultra short or the short term is largely
Right.
used for the cash management tool. So
Okay.
these outflows typically relate to that particular strategy, where the
Hmm.
corporates largely plan their the strategic outflows or traditional outflows or normal outflows, largely attributed towards the taxes,
Hmm.
which gets on a quarterly basis, and therefore this activity is can be related to that. And there's nothing abnormally happening. Let's say had this number would have been very large, then probably
Right.
there you needed to dive deep that where it is
Uh,
happening. But this is a usual activity which keeps happening. It goes on a quarter end, again comes back for the next quarter, and so on and so forth. So our ALMs are also accordingly planned in the short term scheme. So liquidity profile reflects this kind of behavior from the
okay.
corporates. So
Mhm. Right,
yeah.
absolutely. And in fact, my next question was also related to the quarterly redemptions as well. So probably, next quarter would be something in December that we could see some large
Yeah.
outflows from the debt mutual funds in December. So probably the data will come out in January only.
Yeah, absolutely. It goes in. If you observe the previous data also, depending on what kind of, largely you can attribute 75 to 80% towards the advanced taxes and
Hmm.
balance some amount of cash management for the other investment or expenditure purposes by the corporates.
Duly noted on that. I'm sure our
Yeah.
viewers also take note of that. That this sudden spike in redemptions, or you could say the outflows from debt mutual funds, is just a routine measure, nothing to get spooked about. And let me
Absolutely.
also let me also get your perspective on the big debate: can debt mutual funds beat FD's rules? And what are the views and how one should sort of approach this?
Yeah, so this has been a fairly long debated subject, and we have been trying to address this issue See, both are not actually apples if you look at because of the treatment in terms of mark to market. While FD is a straight line product where you get accruals,
Mm,
whatever term you apply your money in the FD market, let's say you've invested for a 5 year period, you will get a straight line accrual. However, in a mutual fund, if you invest in a fund which has a duration of five, there
mm,
will be a volatility which is market related. Now, because if you invest in a time when the yields are slightly headed up or slightly on the higher side, the
mm,
near-term returns get impacted, and therefore people believe that the fixed income funds may or may not be able to. There is an element of uncertainty which erupts.
mm,
However, I just would like to share to the viewers that any fixed income product which is reasonable on the credit profile is likely to achieve the YTM towards the maturity as just similar to an FD. If your YTMs or the yield to maturity of the fund is higher than the FD, to that
mm.
extent, the likelihood of the mutual fund matching or beating the returns is higher. So, to that perspective, if you hold your investments in the mutual fund, debt fund,
Mm,
in line with the maturity profile, which matching the FD instead of the FD what you've done, the
mm,
chances are fairly decent that you are able to match or beat the FD returns is a limited point. But you need to have that objective, that viewpoint has to change
okay.
because people don't appreciate or understand the volatility which comes with the element of duration. Typically, we have habit of looking at the past returns. If the
Yeah.
past returns are good, which means the
Mm,
future has been discounted to some extent. It can happen more, but it has been discounted to some extent, and therefore the returns are much better than the YTMs. And if the returns are worse, which
mm,
means the future is reasonably bright and the returns are likely to get delivered. So that is the time when you can actually get into the fixed income funds.
okay.
Unfortunately, the interest is very lackluster in such times
Yeah.
when the past returns are bad. So this
Right.
is what we I wanted to share with the viewers, investors, that
Mm,
how they should look, because a fixed income product, typically like an FD, let's say 5 year FD, yielding let's say 7% per annum. So the
mm,
cash flows are 777 for the 5 years. Now, if the rates go up, this year return will, let's say for example, be zero. So this 7 rupees which you've not got this year will be
mm,
appropriated over next remaining 4 years. This is
mm,
how the fixed income product behaves. Now, just because it has become zero, some people believe that I'm not going to get my money, money is lost. It is not lost, it is adjusted in the remaining accruals. In a fund, because the maturity profile is not fixed, it
ah,
keeps, it's a volatile thing, but by and large this is how it behaves. And that's the
mm,
time when you need to double up your bets, or you need to look at that in that perspective, that it is probably more attractive and you can increase your allocation if that was the objective. Yeah.
absolutely. And in case somebody who's planning to invest in, debt funds, what is a realistic sort of a long-term expectation from debt funds, which one could sort of expect?
See, Kshitij, since markets are volatile in terms of yields
Mm,
keep changing based on the macroeconomic fundamentals, as of today and the near future, what we can see, the long-term bond yields are in the handle of 7%, 7, seven and a half,
mm,
risk-free sovereign yields. I'm talking about. I'm not talking about corporate bonds. Corporate bonds are tad higher, 50 basis point or so. So,
mm,
long-term expectation can be set accordingly, but you need to observe one phenomena which has been playing out for some time, which is the trending yield in India is getting lower and lower and lower on the long term basis, which is
mm.
reflective of
Okay.
the underlying fundamentals. Long term inflationary pressures are benign. We used to be in a handle of 7 to 8% inflation, which became 5 to 6%. Now
Mm,
it is 4 to 5%, and so on and so
right.
forth. As we become
Mm,
third largest economy, technological impacts, etc., will make sure that inflationary pressures are contained around 4%. Therefore, your
mm,
7 plus kind of handle in the long term bond yields probably will be in the range of 6, or maybe in the range of 5 to 6 also, over a period of
right.
next 3 to 5 years. So,
Mm,
whatever money you are investing today, if you are investing, let's say, after 3 to 4 years, again the same maturity. So you may be having your cash flows, and at the same time,
Mm,
returns are the further yields, forward yields are likely to be even lower, and you will
mm,
be having much larger corpus, and you will be investing at a slightly or maybe a much lower rate from now, is what
mm.
the message is.
Absolutely. In fact, if we dig deeper into the data, it suggests that the long term, that is, let's say 10 to 15 years kind of period, debt has actually provided returns above inflation. And, good time for us that inflation is
Absolutely.
at, multi decades low right now. You think this is the right time to sort of invest and lock yields?
Absolutely, that's what I was trying to highlight. If you
Mm,
believe in fundamentals and the long-term story which is unfolding, see, every economy passes through the same phase.
yeah.
We are also in that cycle. We are in the growth phase. The growth phase will peak out somewhere around in next 5 to 6 years, and then the growth or the demographic dividend which we are getting right now for the next 4, 5 years or 10 years,
Mm,
the market will start discounting the future. And if the growth starts plateauing after 5 years or so or 10 years or so, you will see
mm,
the challenges in the growth coming in because of the demographic fundamentals, and which
sure.
will be reflective in the long term bond yields, what happened in the other major economies. So the moment
Mm,
you reach in the top two, top three economies, this is
mm,
what is likely to happen, and everybody has gone through the same. We will also be in the similar line.
mm,
Therefore, you need to make sure that you are able to lock your retiral corpus at a very healthy rate of
yeah.
7% or slightly higher, so that once these times come in, this becomes a gold mine.
Absolutely. Abhishek, I think it has been very insightful and to understand the nuances of debt funds versus the FDs and how investors can sort of position themselves in the current market environment. We appreciate you taking the time to share your expertise with us. Thank you so much for taking the time out, Abhishek.
Thank you, Kshitij. It was really nice talking to you, and I hope I've been able to add some value to your viewers and the investors, and they'll be able to appreciate more the debt as an asset class in terms of overall asset allocation, and do not ignore this asset class because this provides good amount of stability in volatile times. Thank you.
Absolutely. Thank you so much for taking the time out then, Abhishek.
Yeah, thank you.